Super Microcomputer Inc., widely known as SMCI, is currently trading at $33.52 as of the market close on May 11, 2026. The stock experienced a significant intraday decline of 5.23% during the regular session, though it saw a modest recovery in after-hours trading, inching up to approximately $34.18. This recent volatility is a classic example of the gap between market expectations and the cold reality of hardware manufacturing. While the consensus was braced for a potential cooling off in AI infrastructure, the reality is that SMCI just reported a massive fiscal third-quarter earnings peak, posting an adjusted 0.84 cents per share against the 0.62 that analysts were looking for. However, even with that 35% earnings surprise, the stock is being tugged in different directions because revenue actually missed the mark, coming in at $10.2 billion compared to the $12.39 billion projected. This creates a fascinating curiosity loop. Why would a company beating earnings so handily see its stock price struggle to hold on to gains? The answer lies in the plumbing of the AI world, specifically customer site readiness and the transition to direct liquid cooling technology. Most people looking at SMCI right now see a stock that has lagged the broader S&P 500 recently, but the common ground here is the belief that the AI server gold rush is nearing a peak. I want to challenge that take. If you look at the underlying numbers, Supermicro's gross margins actually improved to 10.1% from a dismal 6.4% in the previous quarter. This margin recovery is the real story that the headlines are missing. The reality is exceeding expectations on profitability, even if the timing of revenue recognition is being pushed out due to logistics. When we talk about NVIDIA stock or the general frenzy around high-performance computing, we often forget that someone has to actually build the racks, cool them, and ship them. SMCI is doing exactly that, but they are currently caught in a transition where they are shifting from being just a hardware provider to a total data center solution provider. This shift is expensive and messy, which explains the negative $6.6 billion in operating cash flow recently, largely driven by a massive buildup in inventory as they prepare for the next wave of deployments. Looking at the institutional activity, there is a clear tug-of-war happening. Short interest in SMCI remains high at roughly 16% of the float, but it has actually decreased by about 7% recently. This suggests that some of the bears are starting to cover their positions as the undervalued narrative starts to take hold. If you're using Robinhood or SoFi Invest to track these movements, you've likely noticed the high volatility score. In fact, option volumes have recently quadrupled their typical levels, with a massive concentration of activity around the 35 strike calls. This indicates that while the stock is down today, a significant portion of the smart friend cohort is betting on a rapid move back toward that $40 level. It is a high-stakes game where the expectation of a supply chain bottleneck is meeting the reality of record-high backlogs. The company explicitly stated that their backlog is at another record high, meaning the demand isn't gone, it's just waiting for data centers to be ready to plug the machines in. For those managing their own portfolios through Interactive Brokers or Schwab Intelligent Portfolios, the question is always about sustainable growth. SMCI's business model is built around building block solutions, which allows them to pivot and integrate new chips from NVIDIA or Intel faster than almost anyone else in the industry. This agility is their primary competitive advantage. While Apple stock might offer stability, and Tesla stock offers a bet on autonomous futures, SMCI is a direct play on the physical layer of the internet. They are the ones putting the GPUs in liquid-cooled chassis so they don't melt while running massive language models. Recently, they even announced an exploratory partnership with Nano-Nuclear Energy to look at how small modular reactors could power the data centers of the future. This is the kind of forward thinking that keeps them ahead, even if the current quarter looks a bit lumpy because a few big customers weren't ready to receive their shipments on time. Recent stock movement has been a roller coaster. Just a few sessions ago, the stock exploded 18% in after-hours trading because the guidance for the fourth quarter was so strong. They are looking at revenue between $11 billion and $12.5 billion for the next quarter, which is well above what the street was expecting. This creates a massive tension. If you're using investing sites to screen for opportunities, you'll see that analysts are divided. JP Morgan and Barclays have been maintaining hold ratings with price targets around $30 to $34, while firms like Needham and Rosenblatt are much more bullish, seeing a path to 40 or even higher. This divergence is exactly where the opportunity lies for individual brokerage accounts. The market is currently penalizing SMCI for delivery delays, while the company is signaling that their order book is bulging. It's a classic case of the market focusing on the when while ignoring the how much. Let's get into the mechanics of what they actually do for a moment.
Supermicro isn't just a server company, they're an engineering firm. They specialize in high-performance, high-efficiency server technology. Their focus on green IT and liquid cooling is becoming a necessity as AI chips draw more and more power. The business model relies on a fast-to-market strategy. When a new GPU is released, SMCI usually has a server ready for it within weeks, whereas larger competitors might take months. This speed is what allowed them to more than double their revenue year over year. However, the risk factor is always going to be component shortages and the concentration of their customer base. When a few giant cloud providers decide to delay a project, it hits SMCI's quarterly revenue hard, which is exactly what we saw in the most recent report. As we look toward the future, the catalysts are quite clear. The expansion of their Malaysia and Taiwan facilities will help lower costs and improve those margins even further. Moreover, the adoption of their direct liquid cooling technology is expected to be a major tailwind. Currently, only a small fraction of data centers use liquid cooling, but as AI workloads grow, that number has to increase. SMCI is positioning themselves as the leader in that niche. If they can successfully execute on their Q4 EPS of 1.9 cents, the current valuation around 18 times earnings might look like a steal in hindsight. Contrast that with the valuation of other tech darlings, and you start to see why 16 different analysts recently revised their earnings estimates upward. Comment below how many shares of Supermicro Computer Inc. you currently hold, or if you're waiting for it to dip below the $30 mark before jumping in. The institutional flow suggests that big players are slowly accumulating on these dips. When you look at Fidelity ETFs or various mutual funds, you'll see SMCI appearing more frequently in tech-heavy portfolios. The volatility is a feature, not a bug, of being at the forefront of a hardware cycle. For those using the Fidelity mobile app or SoFi trading platform, the intraday swings of 5% or 10% can be stomach-churning, but they often provide the entry points that long-term investors look for. The expectation was that the AI hype would subside, but the reality is that the physical infrastructure is still being built out at a breakneck pace. SMCI is essentially the construction crew for the AI world. They might get delayed by rain or supply issues, but the building is still going up. In the final outlook, we have to weigh the risks of negative cash flow and supply chain hiccups against the massive growth in the AI sector. The expectation of a smooth, linear growth path for SMCI was always unrealistic. The reality is a jagged line that trends upward. The tension between the revenue miss and the earnings beat has created a temporary cloud over the stock, but the underlying business fundamentals, specifically the margin expansion and the record backlog, suggest that the core story is still very much intact. Whether you are self-investing or using a robo-advisor, understanding this distinction between timing and demand is vital. SMCI has proven they can build the tech and sell it. Now they just need to prove they can manage the logistics of a $40 billion a year business. To wrap this up, the contrast between expectations and reality in the SMCI narrative is stark. Investors expected perfection across all metrics, and when the revenue timing slipped, they sold off. But the reality of a massive earnings beat and improved profitability tells a much different story of a company that is finally figuring out how to make a real profit on its massive sales volume. The central insight here is that the market is currently pricing in the delay but not the backlog. As those orders eventually ship and the revenue is recognized, the narrative could shift back to one of hypergrowth very quickly. SMCI remains one of the most volatile but potentially rewarding plays in the hardware space, serving as a critical pillar for everything from the next generation of search to autonomous systems. Keep a close eye on those margin numbers in the coming quarters, as they will be the ultimate indicator of whether SMCI can transition from a high-growth hardware shop into a dominant high-margin infrastructure giant. Authority in this market comes from looking past the immediate price action and focusing on where the racks are actually being installed. If the liquid cooling transition takes hold as expected, the current turbulence will likely be remembered as just another entry point in a much larger story of AI expansion. Stay sharp, watch the volume, and remember that in the world of high-tech hardware, the physical reality of the supply chain always has the final word over market sentiment. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.